Expectations are for the Federal Reserve to hike by 50 basis points at their meeting next week, and then to signal another 50 basis points hike. Now, Jerome Powell has said neutral rates at 2.4% is about the right level for rates by year end. However, if the Fed hike by 50 basis points and then they start to show worries about slowing US growth, then markets may begin to sense a pause in rate hikes from the Federal Reserve. Now, that can result in a fall in the US 10-year yields, and that tends to drag the US dollar Japanese yen lower too. Do you see here, the US 10-year yields is the candlestick chart, and the US dollar Japanese yen is the yellow line. And you see how yields lead the US dollar Japanese yen higher. So a move higher or lower in yields is important for the price of the US dollar Japanese yen. So a fall in US 10-year yields would typically result in a fall in the US dollar Japanese yen. It's interesting to note as well that the US dollar Japanese yen now has a strong period of seasonal weakness ahead. Over the last 15 years, the dollar yen has fallen 10 times between June the 13th and September the 1st, with an average fall of minus 1.85%, and the largest fall in 2010 of minus 8.16%. Major trade risks. If the Fed end up being more aggressive this week in the face of high US inflation, then expect the US dollar yen pair to keep gaining. Also, look at the path of US 10-year yields to gauge the direction for the US dollar yen. You can analyse these charts for yourself by going to seasonax.com and get a no strings attached 3-day free trial. Which currency pair would you most like to investigate for a seasonal pattern? Remember, don't just trade it, seasonax it.